Swing Trading. Chapter 13. Advanced Swing Trading Techniques. A price gap tells you that something important changed while the market was closed. The stock opens far enough above or below the prior close that there is a blank space on the chart, and that blank space represents new information being priced in quickly. A gap up means buyers were willing to pay more immediately, while a gap down means sellers accepted lower prices right away. Most of the time, that sudden repricing comes from earnings, guidance, analyst changes, economic news, or some other overnight catalyst. For a swing trader, the gap itself is only the starting point. The real edge comes from reading whether the market will reject that new price area or accept it and keep moving. Once a gap appears, traders usually frame it with one of two basic ideas. The first is a gap fill, where price reverses and travels back toward the prior close because the opening move was too emotional or too far too fast. The second is a gap continuation, where the market treats the new opening price as justified and keeps pushing in the same direction. A gap up can fail and fade lower, but it can also become the start of a strong move higher. A gap down can bounce and fill, or it can continue falling if the news truly changed the outlook. The important point is that the direction of the gap does not tell you the trade by itself. Your job is to determine which thesis has better evidence after the open. Some gaps fill because the opening reaction was more emotional than fundamental. That often happens when traders chase headlines only to discover that the move was overstated once regular trading begins. Other gaps continue because the news genuinely changes how the company should be valued and institutions keep buying or selling after the open. Strong volume, alignment with the prior trend, and steady price action above or below the gap area all support continuation. On the other hand, if price quickly starts retracing into the gap, that is an early clue that the opening move may not hold. None of these signs are perfect on their own. Gap trading works best when you think in probabilities and weigh several pieces of evidence together. A disciplined gap evaluation starts with simple measurement. First, compare the opening price to the prior close so you know exactly how large the overnight move is in both dollars and percentage terms. Many traders pay close attention to gaps in roughly the 1 to 5% range because they are large enough to matter without always being chaotic, though that is only a guideline. Then ask what caused the gap, whether volume is expanding, what the stock had been doing before the open, and whether the first trading minutes show strength or fading. A small gap with no real catalyst may just be noise. A large gap with strong news, heavy volume, and a clean hold can signal a much more meaningful opportunity. A gap fill trade assumes the market will retrace most of the overnight move. If a stock gaps down, the fill idea is usually a long trade looking for a rebound back toward the prior close. If a stock gaps up, the fill idea is usually a short trade looking for price to fade lower. Some traders enter near the open, but many prefer to wait for a reversal signal so they are not guessing too early. A common target is around 80% of the gap distance, rather than demanding a perfect full fill. The stop usually goes just beyond the gap day, high or low, because if price keeps expanding in the original gap direction, the fill thesis may be wrong. This structure helps define the trade before emotion takes over. A continuation trade starts from the opposite assumption. The market is accepting the new price area. For a gap up, that means looking for a long setup, and for a gap down, a short setup. Instead of acting immediately, many traders wait 15 to 30 minutes to see whether the gap level actually holds. If a gap up pulls back but stays above the key gap area, that suggests buyers are defending the move rather than abandoning it. If a gap down bounces but cannot reclaim the gap boundary, that suggests sellers remain in control. Targets can be based on a recent trading range or nearby resistance or support, while the stop is placed near the level that would show the gap is failing. The patience to wait for acceptance is what separates continuation trading from simple chasing. After entry, gap trades usually become short-term management problems rather than prediction problems. These setups often last only 1 to 4 days, so the trade should be reviewed frequently, especially before the close of the first session. If momentum is still strong and the original thesis remains intact, holding can make sense. If the stock stalls, loses volume, or starts moving against the expected pattern, an early exit may be the better choice. One of the biggest mistakes is turning a short-term tactical trade into a long-term hope trade just because it did not work quickly. Good gap traders stay loyal to their process, not to the idea. Targets and stops matter most after the trade is live. Consider a stock that closed at $50 and then opened at $53.20 after a product announcement. That is a 6.4% gap up. And the setup becomes more interesting because the stock was already in a mild uptrend and opening volume is 2.5 times normal. A continuation trader can look at that and say the catalyst is real, trend is supportive, and institutions may keep buying. A fill trader can look at the same gap and say the move may still be overdone in the short term, especially if the first push starts failing. Both readings are reasonable before confirmation arrives. The key lesson is that a gap does not create one automatic trade. It creates a decision point where different plans can be valid if risk is defined. In this example, the continuation trader waits 15 minutes, sees the gap hold, and buys near $53 with a target around 55 and a stop near 50.50. The setup is logical, but logic alone does not guarantee follow through. If momentum fades later, closing the trade for a small loss is still a good outcome because the risk plan worked. The fill trader sees weakness instead, shorts near 53.20, and aims for roughly 80% of the gap, somewhere near the low 50s. When price retraces, that trader exits with a gain because the fade thesis played out. The important takeaway is that good process can produce both wins and losses. What matters is using evidence, setting realistic targets, and controlling downside when the market disagrees. The biggest error in gap trading is treating every gap like an opportunity. Some gaps are too small, too random, too news-driven, or too volatile to trade well. Another mistake is assuming all gaps fill, when many strong gaps continue for days because the market is repricing something real. Traders also get into trouble by ignoring the broader market, entering too early in the opening noise, or placing stops so tightly that normal volatility shakes them out. And if several days pass and momentum disappears, the original edge may simply be gone. The core lesson is simple. You do not need to predict every gap correctly. You need to be selective, wait for confirmation, and manage risk with discipline. Mean reversion looks for a short-term stretch that may snap back toward a more normal price area. After a stock runs too far above its usual range or falls too sharply below it, traders start asking whether the move has become temporarily excessive. That normal area might be represented by a moving average, or it might be a prior support or resistance zone that price often returns to. The idea is not that price must reverse immediately, but that extreme distance from its recent norm can create vulnerability. In practice, mean reversion traders are looking for imbalance. They want to find situations where price has moved far from its center and may be ready to drift back. Stretch moves often pull back for very ordinary reasons. After a fast rally, early buyers may take profits, and new buyers may hesitate because the stock already feels expensive in the short term. After a steep drop, aggressive sellers may slow down while bargain hunters begin stepping in. Sometimes nothing dramatic has to change at all. The move simply cools off because it traveled too far too fast. This is what creates the opportunity for a bounce after weakness or a pullback after strength. That said, a stretched move is only vulnerable, not guaranteed to reverse. The opportunity improves when you can see momentum losing energy. Mean reversion and trend following are built on opposite assumptions. A trend following trader expects strength to keep acting strong or weakness to keep acting weak. A mean reversion trader expects that same move to slow down and at least partially reverse. Because of that difference, timing matters much more in mean reversion. An overextended stock is not automatically ready to turn just because it looks stretched. In strong trends, price can remain overbought or oversold much longer than traders expect, which is why fading momentum too early can be expensive. The mindset here is not to fight every strong move. It is to wait until the moves start showing signs of exhaustion. One common tool for spotting overextension is RSI, the Relative Strength Index. RSI measures recent momentum on a scale from 0 to 100, and traders often treat readings above 70 as overbought and below 30 as oversold. Those levels can be useful alerts because they tell you price has moved strongly in one direction. but they are not automatic entry signals. A stock with RSI above 70 can keep climbing for several more days, and one below 30 can continue falling if pressure is still intense. So RSI is best used as an attention tool. It helps you narrow the watch list, but price confirmation still has to do the final work. The real skill in mean reversion is waiting for proof that the extreme is starting to fade. On the overbought side, some traders look for RSI to move back below 70, which suggests momentum is cooling rather than accelerating. On the oversold side, RSI moving back above 30 can support the idea that selling pressure is easing. Price action matters just as much, especially reversal candles, failed pushes higher after a rally, or failed breakdowns after a decline. Those signs tell you the market tried to continue the move and could not do it cleanly. That is very different from entering just because a reading looks extreme. Confirmation shifts the trade from prediction toward evidence. Bollinger Bands offer another way to judge price stretch. When price pushes into the upper band, it can signal that the recent rally has become extended, and when it reaches the lower band, the decline may be stretched on the downside. But a band touch by itself is not enough to justify a trade. In a strong trend, price can ride the band for multiple sessions and keep moving in the same direction. What becomes more meaningful is when price touches an outer band, stalls, and then moves back inside the bands. That re-entry often shows the move is losing force. So Bollinger Bands are most useful when they help you frame extremes, not when they replace confirmation. Mean reversion works best in the right kind of environment. Choppy, range-bound markets often create overshoots that snap back, because buyers and sellers keep pulling price toward the middle. Strong one-way markets are much less forgiving, especially when momentum is accelerating or major news is driving the move. In those environments, what looks stretched can become even more stretched very quickly. This is why traders warn against trying to catch a falling knife. If a stock is dropping hard with no sign of stabilization, the better decision is often to stand aside. Mean reversion needs tired price action, not panic or fresh momentum. A simple mean reversion process starts by screening for stocks that made unusually large short-term moves and also show extreme RSI readings. After that, mark a likely target area such as the 20-period moving average, because that often acts as the center price may return to. Entry comes only after confirmation appears, such as a reversal candle, a failed continuation attempt, or another clear sign that momentum is fading. The stop should sit at a logical invalidation point, not just at an arbitrary distance. If the stock is making a mean reversion move back toward the average, that average can also be a practical profit target. Some traders scale out there rather than waiting for a perfect reversal. The process stays simple: find the stretch, wait for proof, define risk, and use realistic expectations. Imagine AAPL rallied for 5 straight days and pushed RSI to 78, while price touched the upper Bollinger Band near 160. That gives you the overextended condition, but not the entry by itself. The next day, price weakens and RSI slips to 68, which suggests momentum is starting to cool. A trader might then consider a short entry around 157 after that weakness is confirmed. A stop at 160.50 would sit above the recent high, and a target near the 20-day average around 152.20 gives the trade a clear destination. If price reaches that area within a few days, the mean reversion idea worked as intended. The point is that the trade is built from both stretch and confirmation, not from indicator readings alone. The most common mistake with mean reversion is fading a powerful trend too aggressively. Traders also get into trouble when they use RSI alone. Assume all extreme readings are equal, or ignore whether news is still actively driving the move. Stop placement creates another problem, because stops that are too tight get hit by normal noise, while stops that are too wide can make a small idea unnecessarily expensive. A stretched move in a calm range is very different from a stretched move after earnings or major macro news. That is why context matters so much here. Mean reversion can work well, but only when patience and risk control come first. One of the best ways to learn mean reversion is to observe it before risking money on it. Start by finding a stock down at least 5% in a day, then check its RSI and the 20-day moving average. If RSI is below 30, mark it as oversold and write down the closing price and the distance from the average. Then watch what happens over the next 2 trading days. Does price bounce back toward the average, Or does weakness continue and prove the move was not just a temporary stretch? Repeat that exercise with several different stocks and compare the outcomes. This kind of observation trains your eye to separate ordinary overextension from deeper trouble. Earnings season creates some of the clearest short-term repricing in the market. A report updates revenue, profit, margins, and guidance, so investors suddenly have fresh information about what a company may be worth. Because that information often arrives after the close or before the open, the first visible reaction is frequently a gap. Those gaps can be much larger than normal daily moves, which is exactly what attracts swing traders. The opportunity is not just in the report itself, but in how the market responds once the news becomes public. Some reactions keep running, while others reverse sharply. That reaction is where swing trading decisions begin. A gap fade trade goes against the initial earnings move, but only after that move shows signs of weakening. If a stock gaps up after earnings, the fade idea is to watch for a move back down once buyers lose control. If it gaps down, the fade idea is to look for a bounce back up if sellers cannot keep pressing lower. The key word here is watch, not assume. Earnings gaps can be powerful because they are driven by real information, so fading them without evidence can be dangerous. A valid fade setup comes from the market rejecting the opening move. Until that rejection appears, there is no trade yet. After an earnings gap, the central question is whether the move is failing or holding. A failing gap often shows weak follow-through, such as a gap up that cannot extend and begins forming lower highs. On the downside, a gap down that starts making higher lows can suggest the sellers are losing control and the move may fade upward. A holding gap looks different. Price stays firm, volume remains strong, and there is little meaningful reversal after the open. In other words, the market is accepting the new price area instead of rejecting it. Distinguishing between those two conditions is more important than the earnings headline itself. Many traders wait after the open because the first 15 to 30 minutes often reveal the market's true opinion. Pre-market trading can be thin, jumpy, and less reliable, especially in names reacting to earnings. Once the regular session begins, liquidity improves and the opening range starts to form. That early range shows whether buyers or sellers can actually defend the gap in normal trading conditions. A gap that holds steady during this period may be accepted and continue. A gap that quickly weakens during this period may be setting up for a fade. Waiting a little can feel slower, but it often produces cleaner signals and better decisions. Stock selection matters even more around earnings because volatility can expand quickly. Liquid, widely traded names usually offer tighter spreads, cleaner fills, and price action that is easier to interpret. That is why many swing traders focus on large, well-known stocks that trade millions of shares a day. Low-volume stocks, penny stocks, and extremely thin names can move violently with very little order flow, which makes risk harder to control. Wide spreads can also damage the reward to risk of an otherwise decent setup. So before thinking about the chart pattern, make sure the stock is actually suitable for this style. Better liquidity usually means a more tradable earnings reaction. A basic earnings fade plan starts before the trade, not during the emotional reaction. First, identify a stock that reported before the open or after the close and produced a meaningful gap. Then move to a short-term chart and wait for a reversal pattern rather than entering blindly. In a gap-up fade, a first clear lower high can mark the short entry, while in a gap-down fade, a first clear higher low can mark the long entry. The stop goes beyond the recent swing point because that level should hold if the fade idea is valid. A practical target is often 50 to 100% of the gap, depending on how strong the reversal becomes. Defining those pieces ahead of time keeps the trade from becoming a guess. There is a major difference between holding through earnings and trading after earnings. Holding through the report means accepting pure event risk, because even strong results can produce a sell-off if expectations were too high. In that situation, the market reaction is unknown and often impossible to control overnight. Many swing traders simply avoid that kind of uncertainty. Trading after the report is different because the information is already public and price behavior is visible. You are no longer guessing the news. You are responding to the market's response. That shift from prediction to observation is why post-earnings trading is often more manageable. Take a stock that closed at 100, opened at 109 after earnings, briefly pushed to 110, and then started losing momentum. If lower highs begin to form and volume fades after the early spike, that suggests the gap up move is being rejected. A trader might short near 108 with a stop at 111, placing the risk just above the opening high. If the fade develops and price falls to about 102, the trade captures $6 of reward against $3 of risk. That is a 2-to-1 reward to risk setup, which is solid for a short-term swing. Notice that the entry comes after weakness appears, not simply because the stock gapped higher. The structure matters just as much as the idea. Most mistakes in earnings fades come from acting before the setup is real. Entering before the regular open, assuming every gap will reverse, or ignoring liquidity can all turn a decent idea into a poor trade. Traders also hurt themselves by trading without a stop, especially in earnings names where moves can remain violent well after the open. Another common error is mistaking a pause for a reversal. A stock can stop moving for a few minutes and still continue strongly in the original gap direction. That is why volume, structure, and the first part of regular session trading matters so much. The disciplined process is simple. Wait, confirm, define risk, and only take the clean setups. A useful practice exercise is to study post-earnings charts without placing any trades. Record the prior close, the opening price, and the first 30-minute high and low. Then ask whether the gap is holding above that range or failing back through it. If a fade setup seems valid, mark where an entry, stop, and target would make sense. If no clear setup exists, write down exactly why you would stay out. That final part is important because good trading often includes choosing not to trade. Observation like this helps you build pattern recognition without the pressure of real money. Options are contracts, not shares, and that difference changes how swing traders need to think about them. A call gives the right to buy at a set strike price before expiration, while a put gives the right to sell at that strike price before expiration. The buyer has a right, not an obligation, which is why the maximum loss for a long option is typically limited to the premium paid. Calls generally benefit from rising stock prices, and puts generally benefit from falling stock prices. But because each contract also has a deadline, time becomes part of the trade in a way it is not with stock. Before using options for swings, you need to understand the contract terms as clearly as the chart setup. Swing traders often use options because they can create directional exposure with less upfront cash than buying shares. One contract usually controls 100 shares, so a relatively small premium can represent a meaningful position. That can lead to large percentage gains if the move happens quickly and the contract responds well. Long options also define maximum loss up front, because the most the buyer can lose is the premium paid. Puts add another advantage by allowing bearish positioning without needing to short stock directly. Still, lower cash required does not automatically mean lower practical risk. Leverage makes good outcomes larger, but it can also make mistakes expensive very quickly. With options, being right on direction is only part of the job. A stock can move the way you expected, and the option can still disappoint if the contract was overpriced, too far out of the money, or too close to expiration. Options need enough stock movement, but they also need that movement to happen soon enough. If the stock drifts instead of moving decisively, the option may lose value even while your general thesis stays intact. Entry price matters too, because buying rich premium can limit returns from the start. This is why options require a more complete view than stock trading alone. You are trading direction, timing, and contract quality all at once. Two of the biggest risks in long options are time decay and implied volatility. Time decay means the option loses value as expiration approaches, even if the stock does nothing wrong. A slow, correct idea can still lose money simply because the contract is running out of time. Implied volatility, or IV, affects how expensive the option is before you buy it and how much value it can lose if that volatility drops. This is especially important after events like earnings, when IV often collapses once the news is out. So a stock can move in your favor and the option can still underperform because time and volatility work against you. That is why option swing trading cannot be evaluated by direction alone. An option premium has two main parts: intrinsic value and time value. Intrinsic value is the amount the contract is already in the money right now. For example, a 95 strike call on a $100 stock has $5 of intrinsic value because it already gives the right to buy below the current stock price. A 105 strike call on that same stock has no intrinsic value yet because the stock is still below the strike. Any premium on that out-of-the-money call is all time value, which reflects future possibility rather than current profit. Understanding that split helps you judge whether you are paying for real value, hope, or a mix of both. The simplest option swing process begins with a normal stock setup. If the chart gives you a bullish thesis, you can consider buying a call, and if it gives you a bearish thesis, buying a put. The trade still needs a clear target, a loss limit, and a reason to exist before you choose the contract. Most swing traders who buy options are not planning to exercise them. They expect to sell the contract to close once the move develops or the idea fails. That means you are managing the option as a short-term trading vehicle, not as a path to stock ownership. Keeping the stock set up first and the option second helps maintain discipline. The contract should serve the trade thesis, not replace it. Choosing strike and expiration is where many option trades succeed or fail before they even begin. Out-of-the-money contracts cost less, but they need a bigger stock move before they gain value meaningfully. At-the-money contracts cost more, yet they usually respond faster and more reliably to short-term price movement. Very far out-of-the-money options may look cheap, but cheap can simply mean unlikely to pay well. Expiration matters just as much. A common guideline is to buy 1 to 2 weeks beyond your planned holding period so the trade has some breathing room. Very short-dated options are less forgiving, because time decay accelerates and small timing errors become expensive. A comparison makes the trade-off clear. If a stock rises from 100 to 108, buying 100 shares produces an $800 profit on a $10,000 position, or about 8%. Suppose instead you bought one 105 call for $2, or $200 total. If that call rises to about $5, the profit is $300, which is a 150% return on premium paid. That kind of leverage is why options are attractive. But if the stock only reaches 103 by expiration, the stock position is still up, while the call may expire worthless. So options can magnify gains, but they can also go to zero much faster than stock. A call often makes more sense than stock when you expect a sharp move over a short time and want to keep maximum dollar risk small. In that situation, defined risk and efficient capital use may matter more than long-term staying power. Stock is often the better choice when the move might take longer to develop, or when you want less sensitivity to time decay and implied volatility. Stock has no expiration date, so it gives the idea more time to work. Calls are less forgiving if timing is off, even when direction is right. So the choice comes down to the kind of move you expect and the type of risk you are willing to carry. Options are not automatically better. They are simply a different tool. Many option losses come from contract selection mistakes rather than from a completely wrong market view. Traders often ignore time decay, choose expiration dates that are too close, or buy strikes so far out of the money that the stock would need an unrealistic move. Others forget that implied volatility can fall and damage the contract even if the chart idea was fine. Another common mistake is holding weak trades all the way to expiration instead of exiting when the thesis no longer looks good. Because long options can lose value quickly, trade management matters a lot. Some traders even cap losses at a set percentage of premium, paid to avoid letting small contracts become total losses. Discipline in selection and exits is what makes options usable for swing trading. Sector rotation is the movement of capital from one part of the market to another as expectations change. Investors may shift money toward technology, energy, healthcare, financials, or defensive groups depending on growth, rates, inflation, and earnings trends. For swing traders, this matters because leadership is rarely spread evenly across the whole market. One sector can be attracting steady buying for weeks, while another stalls or fades. That flow of money helps explain why similar chart setups can behave very differently in different industries. Sector rotation creates context for stock movement. It often drives the multi-day and multi-week trends that swing traders want to capture. A strong stock has a better chance of following through when it belongs to a strong sector. In that case, the sector acts as a tailwind because institutions are often allocating money to the whole group, not just one name. The opposite is also true. A good-looking stock inside a weak sector may struggle because the group itself is under pressure, creating a headwind. This is why sector context can improve the odds of a trade without guaranteeing it. When a sector is in favor, several stocks inside it often rise together. That broad participation is an important clue that the move has depth, rather than being just a one-stock story. You do not need to predict the economy perfectly to use sector rotation well. What you need is a practical read on the current backdrop. Watch interest rates, inflation data, employment trends, earnings behavior, and the tone of the broader market. Then ask which types of sectors should benefit from that environment. For example, improving risk appetite may support growth sectors, while uncertainty may send money toward more defensive groups. The goal is not to force a macro narrative. It is to build a workable map of where capital seems likely to flow and then check whether price action confirms that idea. Different sectors often tend to lead at different phases of the market cycle. Early recovery periods frequently favor technology and consumer discretionary because investors start leaning toward future growth. Mid-cycle growth often lists industrials and financials as economic activity broadens. Late cycle or inflationary periods can favor energy and materials, especially when commodity pricing strengthens. In more defensive or uncertain environments, utilities, healthcare, and staples often hold up better than the rest of the market. These are useful tendencies, but they are not rigid rules. Price action still has to confirm which groups are actually being accumulated right now. Sector ETFs are one of the easiest ways to confirm whether rotation is real. Instead of relying on headlines, you can look directly at funds like XLK for technology, XLE for energy, or XLU for utilities and see where sustained strength is showing up. A true leadership group often displays higher highs, higher lows, shallow pullbacks, and stronger volume on advances. It also tends to outperform the broad market on a relative basis, not just bounce for a day. That relative strength matters because real money flow usually persists over several sessions or weeks. Sector ETFs help you separate one-day excitement from actual leadership. They turn a broad idea into something you can measure on a chart. Once you identify a leading sector, the next step is to find the best stocks inside it. Not every stock in a strong group will behave equally well, so you still want names with cleanup trends, rising relative strength, and constructive pullbacks instead of sloppy breakdowns. Healthy setups often show support holding and volume increasing on up days or on breakouts. This helps you avoid buying the weakest member of the strong group just because the sector itself looks good. Think of sector rotation as the filter and stock selection as the refinement. The best swing candidates usually align both group strength and individual technical quality. A solid trade plan should connect the individual stock to the sector trend and the broader market. If all three are aligned, the setup often has a better chance of follow-through. Entry might come on a pullback, a support test, or a breakout, but the decision should still make sense within the sector's trend. The stop belongs below a logical technical level where the setup would be invalidated, not just where the trader feels uncomfortable. Just as important, you should monitor both the stock and its sector ETF during the trade. If the stock looks fine but the sector starts to weaken sharply, that is information you should not ignore. Alignment improves trade quality, but it also needs to be monitored continuously. Imagine the broader market is starting to recover after a weak stretch and XLK has been trending higher for 3 weeks. That suggests money is rotating into technology, especially if the ETF keeps making higher lows with steady buying pressure. Inside that stronger group, MSFT may stand out because it is also trending up and outperforming. If MSFT then pulls back about 3% on light volume, that often looks constructive rather than bearish. The stock is resting within strength instead of breaking down. A trader could use that pullback as a swing opportunity, then plan to exit near resistance or reduce exposure if XLK itself begins to weaken. The sector trend adds confidence, but the stock still needs its own valid setup. Common mistakes in sector rotation usually come from chasing stories instead of reading charts. Traders often buy after a sector has already gone vertical, ignore a weak, broad market, or mistake a one-day bounce for real leadership. Another error is trusting headlines without checking whether price and volume actually confirm accumulation. Leadership can also fade, and holding on after that happens can turn a strong swing into a weak one. Sector rotation is most useful when it helps you act early and selectively, not when it encourages late chasing. The chart should always decide whether the story is real. The practical takeaway is to trade with current leadership rather than against it. Start by finding sectors that are showing real strength, then confirm that strength with ETFs, price structure, and relative performance. After that, choose stocks that align with the group and offer clean technical entries rather than extended ones. If momentum becomes crowded or starts fading, reassess instead of assuming leadership will last forever. You do not need to predict every sector shift in advance. You just need to recognize where institutional money is flowing now and manage risk while that advantage is still present. Time-based patterns matter because they can help narrow your focus before you even look for a chart setup. Certain months, weeks, and business seasons tend to create recurring behavior in stocks, sectors, or indexes. That does not mean the market repeats perfectly, only that some windows have historically shown a directional bias more often than others. For swing traders, that kind of context can be useful because it matches the multi-day to multi-week holding period well. The value is probabilistic, not predictive. These patterns can improve where you look, but they do not replace chart confirmation or risk control. Calendar patterns and seasonal patterns are related, but they come from different sources. Calendar patterns are tied to dates or recurring periods, such as month-end, quarter-end, or even day-of-week effects. Seasonal patterns come from business cycles and recurring demand, such as holiday retail strength, energy demand in winter, or behavior around earnings seasons. That distinction matters because it changes how you frame the trade. A calendar pattern is more about timing in the market schedule. A seasonal pattern is more about recurring economic behavior in a company, industry, or sector. Knowing which one you are using helps you build a more realistic expectation. Several calendar patterns show up often enough to be worth monitoring. Small caps are sometimes associated with January strength, September is often viewed as a weaker month, and large caps can benefit from fresh quarter flows as institutions rebalance. Even weekdays can behave differently, with Mondays and Fridays sometimes showing distinct trading tendencies. For swing traders, the most useful patterns are the ones that line up with a holding period of several days or a few weeks. You are not trying to memorize market folklore. You are looking for recurring windows that may slightly improve timing when the chart also cooperates. The pattern gets your attention, but it should not make the decision by itself. Seasonal patterns tend to come from recurring business and demand cycles. The phrase "sell in May" reflects the idea that some periods from May to October can be weaker, though the effect is far from guaranteed. Retail stocks may strengthen ahead of major shopping seasons, energy names can respond to seasonal demand, such as winter weather, and some individual stocks show recurring behavior around earnings windows. These tendencies can create useful watch list themes, but because they come from broad cycles, they still need current chart evidence to become tradable. A good seasonal window simply tells you where to pay closer attention. The actual trade still depends on present-day price behavior. Historical patterns are best used as context, not as a standalone signal. A tendency that worked repeatedly in the past can fail in any given year because earnings, rates, macro shocks, or broad risk-off selling can override it completely. That is why pattern-based trading becomes dangerous when the trader treats history like certainty. Instead, think of the pattern as a background condition. It may support a bullish or bearish idea, but current market conditions still have the final say. Price action must confirm the setup before capital is committed. In practical terms, the calendar gives the theme, and the chart gives the trigger. Once you have a favorable time window, you still need technical confirmation. That confirmation might be a breakout above a moving average, a bounce from support, a bullish reversal candle, or a breakout accompanied by strong volume. Each of those signals tells you that buyers are actually stepping in now, not just that the seasonality looked promising on paper. Without that kind of trigger, a pattern remains an idea rather than a trade. This is especially important because many seasonal setups arrive while the chart is still weak or undecided. Waiting for confirmation keeps you from buying too early just because the calendar says you should. The best use of seasonality is to focus your attention until the chart agrees. A practical workflow makes seasonal ideas much more useful. Start with the relevant time window. Then check whether there is enough historical support to take the pattern seriously. After that, Add technical analysis by looking at trend, support, and resistance, momentum, and volume. If the chart offers a valid setup, build the trade plan before entering by defining entry, target, stop, and holding expectation. Position size should reflect the idea's uncertainty, because seasonality is never guaranteed. This sequence matters. A broad pattern becomes actionable only after it passes through evidence, chart structure, and risk planning. Suppose late November puts retail stocks on your watch list because the holiday shopping season is approaching. You check the history and find that WMT rose in 8 of the last 10 Decembers, which gives the seasonal idea some support. That still is not enough by itself, so you look at the chart and see price break above a bullish flag. A trader might enter around 172 with a stop near 165, creating a defined risk plan. If the stock then rises and is sold near 183 after about 8 trading days, the trade worked because seasonality and technical confirmation lined up. You can make the idea even stronger if other retail names such as TGT or Cost also look constructed. The lesson is that the seasonal theme starts the process, but the chart and plan complete it. Most mistakes with calendar and seasonal patterns come from giving the pattern too much authority. Traders often buy simply because a favorable month has begun, ignore the broader market trend, or rely on too little historical data to justify the idea. Others hold too long and overstay the expected window even after momentum fades. Risk can also become unbalanced when a familiar pattern creates false confidence. A tendency is not a guarantee, and every year can behave differently. That is why planning still comes first. You need a chart setup, enough history, an exit plan, and a risk size that assumes the pattern may fail. The key takeaway is that calendar and seasonal patterns work best as filters, not as signals. Use them to identify recurring time windows that may deserve extra attention, then verify that the pattern has enough historical support to matter. After that, require a technical trigger so the chart confirms the idea in real time. Before entering, define the entry, stop, and exit, just as you would with any other swing trade. And always assume the pattern can fail, even if it has worked many times before. Used this way, seasonality can improve timing and selection without replacing disciplined analysis.